sip a day keeps volatility and inflation at bay. Equity markets are volatile, but that's exactly where a systematic investment plan scores over one-time investing.
Equity gives you better return than inflation, better return than fixed income. If this is the belief, and then it comes in very erratic manner. It is not a 18%, 20%, or 15% yielding fixed income return. It doesn't get you don't get this return every year. So what you got last year, or we got negative return in 2018 and 19. 2020 turns out to be very surprisingly a positive year for equity, despite the big decline. So far, year to date, we are, the market has gone up while the economy, everybody's pointing fingers at why so. So this will keep happening, and over a period of time, high quality companies will be able to beat inflation, and that should be how to convert this volatility, the extremes of the equity behavior, how to convert it to your advantage. The simplest and no nonsense way, which can be implemented by any individual investor, is be a periodic investor.
Always save up money for a rainy day, because you never know when a thunderstorm strikes and takes away your income, leaving you with a whole lot of expenses to pay for, just like what we saw during the pandemic. Well, the equity markets are rallying, and how? Your portfolio is surely reflecting all those massive profits and gains. But don't be tempted to just book those profits. Ensure you have a proper plan of where you're going to deploy those sales proceeds.
Mutual fund investors, if you are booking profits or something like that at this juncture because you are thinking that the markets are overheated, where are you going to invest? Are you going to invest that money back into fixed income or do something else? And as you said in the beginning of the show, that if it was asset rebalancing or goals, that's different. But if you are just doing this exercise only for the sake of booking profits, my suggestion will be don't do that, because you are in for the long haul. Equity markets, when you're investing, you are not investing for 30, 40, 50% returns. You are investing for multiplying your wealth 10, 15, 20 times. And that's what has happened in the last 20 years.
Interest rates are only going lower, which means your fixed deposits are not generating as much income as they did maybe 2 years ago. But there are a ton of options that can help you cover up on those low interest rates. Like we on the Money Show have told you, some of them are of course debt funds, but with debt funds as well being a little skittish of late, you can opt for a whole host of government schemes. For example, senior citizen savings schemes, Sukanya Samriddhi scheme, or even for that matter, the RBI's floating rate bonds. In fact, even the fixed deposits offered by small finance banks offer you at least 1% better returns than a regular bank FD. Feeling the pinch of really high EMIs? Well, if you keep your credit scores up, you can bring your interest costs down. How can you keep your credit scores up? Well, we on the Money Show have brought to you tips that will help you do exactly that.
There are 2-3 options. What you can do is loans like home loans, these days even most of the auto loans, the lenders do allow you to do part payment. So if there is any sudden bounty that is coming, you could put that money down and reduce your EMIs. So per monthly cash flows are positively taken care after that. That's option number 1. Option number 2, if age is on your side, you can always go back to your lender and see if your tenure can be extended so that your monthly EMIs either remain the same or they further get reduced. Make sure that you don't default, you make payments on time, and these days even if you are facing any kind of cash crunch or job loss, not able to pay, it is always important and essential that you talk to your lender, explain the situation. If you don't communicate and you start dodging their calls, not make payment, you are then inviting more trouble for yourself. So be upfront, call your lender, explain the situation and see what can be done to improve the current situation. Overall, for you to improve your credit scores, have a very diversified portfolio. Don't go for only personal loans, only credit cards. Don't keep applying for loans and cards even if they are getting rejected, because more inquiries can adversely affect you. And look for loans where, before you go for another loan, see that your earlier loans are properly closed and get them updated with the bureau.
Has all the trading and investing that you've done made you a richer person? Have you enjoyed capital gains? Made you the wolf of Wall Street? But guess what? The taxman is going to be eyeing those capital gains, as you'll have to pay a 10% tax on even long-term capital gains. There's a very simple method then to manage your profits in such a manner that your tax bill is down to the minimum. As you know, tax is imposed if your long-term capital gains is more than 1 lakh rupees. So a simple trick is ensure you book your profits before they touch 1 lakh rupees. And if you continue to have conviction on the investment that you just booked out of, you can always rebuy the shares the next day. Salaried people often complain that they are on the receiving end of the tax bills. The tax is cut upfront, and plus there are limited avenues available to them that can help them bring down the taxable income. But here are some simple tips and tricks that can help minimize your tax bill.
One thing that I've seen in my clients, and which people who are salaried individuals can take care of, is the HRA component. So I'll just break it down. HRA, first off, if your employer is not giving you HRA, then make sure you tell your employer that you need to have an HRA component, especially if you're staying in a rented apartment. That is one. So go and talk to your employer about this. Go to talk to your HR in case they're not giving you the house rent allowance. Second is whether you're staying on rent, genuinely you're staying on rent, and sometimes when you're staying with your parents also, it's a very good tax planning mechanism whereby you pay rent to your parents. And I'm not saying that this has to be anything wrong. It is genuinely a payment that you make to your parents. Instead of paying them money at the end of every month, why don't you enter into an agreement with your parents saying that I'm paying you 30,000 or 25,000 or 40,000 every month as rent. What will happen is they will get some income to show, and they have an exemption limit which might be higher, sometimes 3 lakhs, sometimes even 5 lakhs. So they might not land up paying any tax. And you, because when you pay them rent, and that rent can be taken as a deduction in HRA. So what a lot of people do is they get HRA, but they don't take this deduction because they say, I'm staying with my parents, how can I take a deduction? There is a new deduction actually, not very new now, but there's a deduction called 80GG. In that, if you're actually paying rent, if you're staying in a rented apartment and you don't get HRA from your employer because either he's missed out on it or his tax structure does not have an HRA, then also you can get a deduction of up to 60,000 rupees.
Want to buy health insurance but always feel like you're short on cash? Well, that's where multi-year insurance comes in. Instead of paying premium every year, you can pay premium for multiple years together. This leads to 20 to 30% savings in premiums, plus better no cash bonuses as well. A simple trick that will ensure you purchase adequate health insurance for yourself while saving on your premiums. Life is priceless, but if you have to buy life insurance, you have to put a value to it. What exactly is it that your loved ones will need in the event of your passing away? What will be their needs and requirements from a financial perspective? It's almost impossible to put a value to that. Well, here is some simple tricks and tips on how to go about deciding what should be the value of the life insurance you must purchase.
If you're buying a life insurance product for the first time, or you're buying it for the 5th time, the first thing that you must remember is that the cover that you should have, the protection that you should have, or what we call is the sum assured that you should have in case something were to happen, should be minimum 10 times your expenses. If you are younger, below 40, this could be 15 to 20 times your expenses. And if you're above 40, it must be minimum 10 times your current expenses. And the rationale for that is simple, that in case something were to happen to the breadwinner of the house, and say he was providing 1 lakh rupees of income that helped the family take care of its expenses, then if I'm not there, I should have 10 times 1 lakh, which is 10 lakhs. And this 10 lakhs, which is paid to the nominees of the family in case of an eventuality.
whatever your age, ensure you make a will of all of your assets and liabilities. It ensures that in the event of your unfortunate demise or passing, your heirs, your loved ones are the rightful owners of all the assets that you have accumulated for yourself and all the wealth you've accumulated for yourself after all those years of hard work. It's a very simple process that does not even involve too many legalities. Get right to it and ensure that it is always up to date. Do you feel like you're running out of money at the end of every month? Well, here's a simple mantra that will ensure that you properly budget for yourself. When you get your salary at the end of every month or at the beginning of every month, immediately cut off 20% of that salary and transfer it to another savings account that should be absolutely untouched. 50% of that income then can be used towards your essential expenses, and then whatever's left can be used for your discretionary purchases. For example, if there's an outfit that you've been eyeing since a very long time, the money that is saved and lying in a savings account should then be properly and systematically invested.